What's the average terms we are selling this? This much of inventory within a year, we will sell more than 8 times, 10 times, 11 times. So then it means that average turnover means within a year, this much of inventory, what's the term? What's the frequency? We sell this inventory item. So then as a management, we are trying to increase this. Let's say we have a answer 10. Answer 10 means, what do you mean by that? Inventory turnover 10. ඒ කියන්නේ මොකක්ද? අපේ average inventory වගේ 10 මාරක් අපි විකුණලා තියෙනවා. 10 times we sold like average inventory. It means we have 360 days per year divided by 10. Average inventory item එක කොච්චර කල් තියාගන්නවද කියලා බලන්න. So then what's the equation? 360 divided by inventory turnover. 360 divided by inventory turnover. You are getting inventory holding period. Inventory holding period. Inventory holding period. 365 divided by inventory turnover ratio. In other words, we can say that average inventory divided by cost of goods sold into 365. This is average inventory holding period. Average inventory into 365 divided by cost of goods sold. Make a තව විදියකට formula. You know that, right? So after inventory turnover ratio, 365 divided by inventory turnover, multiply by inventory turnover එක denominator එක උඩට අරන් numerator එක යටට ගත්තොත් you can put the multiplication mark, right? Basic max, right? 365 divided by inventory turnover ratio. This is a ratio you can understand. Easily you can understand. 360 divided by inventory turnover ratio. Inventory turnover ratio, in other words, cost of goods sold divided by average inventory. So make a divide කරන එකනේ. Multiply කරන්න නම් numerator and the denominator you need to shift. So then you can put that 365 into average inventory divided by cost of goods sold. You can write the formula like this. Right? Likewise, we have 3 different turnover ratios. Account receivable turnover. So the inventory turnover, then account receivable, then creditor turnover. So then what we are going to do now? We are trying to explain efficiency in the process, no? Efficiency in the process. Efficiency in the process. Efficiency means as a company, you are selling, you are buying from vendors. That's called the purchase item. We call inventory, right? This inventory will sell to creditors, debtors. That's called debtor. This debtor will give cash to the organization. That cash will be settled to vendors, creditors. That's the overall process in organization. We are purchasing on credit basis. We are keeping inventory. We are selling to debtor. Debtor will take some time to settle cash. That cash will be collected. That will be given to creditors. Again, we are buying. That's kind of a circle. We have 365 days. 65 days. Within this 365 days, how many cycles we had? How many cycles? Number of cycles you can do. Let's say 10, 20, 50, 100. That depends on your efficiency. If you can do this 100, if you have a margin 30%, one time if you can do 1 million, 1 million into 30% into 10, your earnings. Your efficiency means how many times you can repeat your operating cycle. So then, in accounting terms, what do you mean by current asset? Current asset and current liability. As well, case one. Current asset. You know, right? Current asset means current asset, current liabilities. Current asset. Yeah. Then money. That is the normal understanding you should have. Asset we are keeping another 1 year period. In other words, asset we are keeping for shorter period. Right? The exact definition as well case one. Current asset. The asset we are keeping for the next operating cycle. That's exact what given in the standard. If we can sell, dispose, or realize within the next operating cycle, called current assets. Right? So then you need to measure current asset based on your operating cycle time. If it is, if you are having operating cycle like 6 months, your operating cycle period is 6 months. 6 month period operating cycle. Whatever the asset will realize within this 6 month period will be the current assets. Not the 1 year. Right? Not the 1 year. You have to have a kind of a judgment about the operating cycle. As a flat rate, it's really difficult to giving kind of an average operating cycle. That's why we are keeping 1 year as an average operating cycle. That's why 1 year, make it about the current year. Accounting question කරන්න. ඒ 1 year කියලා ගත්තා. ඒකත් අහන්න. ඒක අහුවට පස්සේ තමයි මේක ආන්සර් එකේ. So then 1 year is the average operating cycle given for each and every organization. That's why we are using 1 year for current assets. Right? But that definition clearly says whatever the assets you realize within another operating cycle, you should consider as a current asset. And what you mean by current liability is same way. Within one operating cycle, you need to pay that it out. That may be current liability. Right? Current liability. ඒක හොඳටම තේරෙනවා අපිට නේද? Current liability කොම අවුරුද්දක් ඉන්න පුළුවන්. Current liability කොම අවුරුද්දක් ඉන්න පුළුවන්. ඒක මාස 6 වෙන්න පුළුවන්. අවුරුද්දක් දෙක current liability එකේ නඩු වෙන්න පුළුවන්. ඒක පරිදි පද්ධතිය. Within another operating cycle, you need to pay it out. That's the real definition, right? Yes. Oh, why industry දෙක current ratio අරගෙන බලන්න එපා. industry දෙක current ratio අරගෙන compare කරලා බලන්න. different treatment කරන්න. So you can't compare. අපි ගන්න එක ප්‍රශ්න solvency, type of then gearing ratio. We have common ratios we can compare. But if you are comparing current ratio in between two industries, we should know what it is. Some of the companies, they are not doing, credit sales. They do have only cash sales. It means that they don't have current liabilities. It is so. That based on the industry mix. If you are comparing insurance to banks, you need to be careful that. What are the asset categories they do have? In a bank, what are the current assets, current liabilities? In an insurance company, what are the current assets? Normally, insurance premium, we have to give 60 days credit period. The credit term is a must. Credit term is a fact meaning evaluate. That industry whether they are giving credit terms or not. That should be evaluated once you are doing ratio analysis. Right? Before you are comparing that current ratio between two industries, you need to evaluate that age of that industry plus credit terms of that industry. Whether they are doing credit sales, what is the credit period, so එකම ඉන්ඩස්ට්‍රි එකේ කම්පැනි දෙකක් බලනවනේ. එකම ඉන්ඩස්ට්‍රි එකේ කම්පැනි දෙකක් වා කම්පෙයාර් කරන්න. එක කම්පැනි එකක් ඩීටේල්ස් වලට 6 months level. තව කම්පැනි එකක් 1 year level. So then obviously your debtor balance may be higher. One company, each company, the company was given higher debtors at overdue period, credit period, they are having high debtor balance. That's obvious. That's the reason for that. With having that reason, you have to compare that ratios. Then only you can give an exact interpretation for the ratios. Otherwise, you are getting kind of a wrong question. Right? So then here, we have already discussed inventory turnover. Now we are going to debtor turnover. All together, we can say that cash cycle. Cash cycle. Cash conversion cycle. We are calculating cash conversion cycle. Means that the operating cycle, within this cycle, number of days you will take to convert cash. Convert to cash. Convert to cash means if you have inventory item today, which date you are going to convert to cash? You are holding inventory this much of period. You are selling it out, and then debtor will settle cash this much. Debtor holding period. So then only you are getting cash. Likewise, you are calculating cash conversion cycle. So then number of cash conversion cycle within a year will reflect the efficiency of the organization. So then whatever the organization you are heading, you are going to lead, try to have more operating cycle within a year. That's all about efficiency. Operating cycles lead control. Marketing and so then you have to give discounts and different strategies. Production level, marketing level, then recovery level, different strategies. To have more inventory, more production, you have to have different efficiency level measures. To have kind of to decrease the delivery time, to a delivery efficiency, and then to recover cash, you have to give some cash discounts to recover cash early. And then if you can get some of the period to settle creditors, that's a benefit to the organization. Creditor settlement period, right? So then you want to get cash early from debtors, you are getting some delays. You want to get some times to settle creditors. It will secure your liquidity. Right? Liquidity means within this cycle, if you are circulating cash without any headache, without any gap, that's all about what? The liquidity. Right? Liquidity. The going concern means, solvency means, we are having this type of cash cycles more than 10 years, more than 5 years. If you can generate these cycles without kind of a long-term financial impact, that is called solvency. That's all about operation. So then what you want is kind of a holistic picture about all the ratios. එක ratio එකක් ගැන නැත්නම් බලන්න ඕන. හැම ratio එකම link කරගන්න. Then only you can have kind of a picture. As I said previously, after seeing numbers, after seeing balance sheet, you can see some of the ratios and you can give the kind of a reasons and the background of the organization after having this knowledge. So then basically you should know the exact ratio, what it is, the logic behind that, and the link between other ratios. That's the important aspect. Link between operating cycle to asset holding period to the current ratio to the earning per share to the PE ratio to the profitability ratio. Should have a link. The one can pull up profitability වැඩි නම් අනිවාර්යයෙන්ම liquidity හොඳ වෙන ගමන් asset turnover එක වැඩි වෙනවා කියන්නේ. So that's the link you need to maintain. Right? Okay. So then we are going back to debtor turnover. For debtor turnover, in other terms, receivable turnover, you are getting credit sales divided by account receivables. Credit sales divided by account receivables. Then again, two different concepts. Credit sales is a P&L concept or the period concept. And then average account receivable. Account receivable is a asset day concept, balance sheet item. So then we are getting average account. Average receivable and then credit sales. From the formula, what do you mean by? What's the meaning? What's the real outcome? This is account receivable turnover ratio. How we are going to give kind of a definition to this? What a formula එක අතේ ලියන් ඇවිල්ලා අනිවාර්යයෙන්ම ගාන හදන්න පුළුවන්. නේද? ඒ කියන්නේ මේ 2 වල විතරනේ දෙකල මෙතෙන්ද ලියා ගන්න formula එක. බලලා ගාන ගන්න. ඒක ratio එක කරද්දී අපුල් භාගයේ කවුන්ටින් සෙල්. ඒක වැඩක් නේ. What do you mean by credit sales? For the period concept, right? And then average account receivable as it's a kind of a balance sheet item. So as at the reporting date, you may have receivables. So then what you have to do is to divide credit sales by using balance sheet items, we need to get the average receivables. Right? Average receivable we compare with the credit sales. It means within a period, how many times, what's the time, what's the frequency we did our sales? We compare with the receivable. We have kind of a receivable balance. So average receivable, it may be 100. So then we compare it to this 100 receivable item. During the period, we have 1,000 credit sales. It means comparing to our receivables, we do sales more than 9 times. Means more than 9 times. It's all about 10 times, right? So then your credit sales 1,000, your credit sales 1,000, your receivable balance 100. It means that during the period, you have done sales like 10 times of your receivables. So then, what do you mean by account receivable turnover ratio? That's a ratio which will reflect your sales frequency to the receivable value. The receivable value. So what is receivable and what turnover I have to do? Come on. What receivable නැත්තම්? What receivable නැත්තම්? In other terms, you don't have credit sales. You don't have credit sales. Then this ratio is irrelevant. If you don't have credit sales, let's say you have one for the answer. Your credit sales equal to debtors. बाकी में यहाँ उनसे debtors लगे. पहला का हम लोग जाना था. पहला का हम लोग जाना था वर्षा ratio. Equal to 1. Your credit sales divided by receivable reflect 1. It means whatever the sales you have done this year remaining as receivable. वाके ratio का 0.5 नाम कर लगा दी 0.5 वाट में आवुद्ध विकरण को हम मिलाना है या आवुद्ध विकरण काम debtors level के ना के क्या right I'll get it what we are having 0.5 ratio. It means that your last year is the balance also it's a kind of very serious question, right? After doing this analysis, if we can say that high is generally better, yes, high is generally better, but too higher might indicate that the firm is denying credit to the customers. If the ratio is too low, it would suggest that firm is having difficulty collecting on-site sales. This is particularly true if we find that account receivable are increasing faster than sales for a prolonged period. Sales are the here level. But the percentage again, higher amount is better. Higher amount is better. Too much higher. Again, dark very damage. Again, move up damage. It means they are not keeping. We do credit sales. We are not keeping debtor balance more. We try to collect this. Try to collect this immediately. It means, in other terms, we are not giving credit period. We are not giving credit period to credit-worthy customers. Credit-worthy customers. Credit-worthy after customers credit देंगे यहाँ पे. Why? We want to have cash immediately. We are trying to have higher debtor turnover. So rapidly liquidity market company का market. Edover, you are a person, you are in a competitive industry. Other competitive company, they will be kind of a data period, right? So then, to do the competition, definitely you have to promote credit sales. If you are not giving that, definitely, you will lose the market because you are not promoting any credit sales. You are not giving that. Why? Because you can't do that. What is the credit period? What survive in the product pickup? වාට දාන්න ඕන කුක්සි දෙකකට ස්ටීල් සුපර් මාකට් හරි නෝ මාකට් හරි. යාලා ගෙවන්නේ after 3 months. වාට එකට සර්වයිව් වෙන්න බැරි නම්. You can't say that. වාට ඒ වගේ ලොකු කම්පැනි එකකට ප්‍රොඩක්ට් එකක් දාන්න නම් යාලා අනිවාර්යයෙන් මෙයාලා ඒක ඉතල ප්‍රොමෝට් කරන්නේ. ගොඩාක් ප්‍රොෆිටබිලිටි වෙන්න. යාලා අනිවාර්යෙන් සප්ලයර්ස්ට ඩිමාන්ඩ් කරනවා පේ කරන්න. It will take like more than 2 months, 3 months to settle. Do the settlement. So then if you want to put some items to the supermarket, then you have a kind of a capacity to maintain your receivable more than 3 months, 4 months time. Then only you can increase your sales. That's all about your liquidity. That depends on your liquidity. Keep in mind. Right? So they want to analyze it. All those things is a matter. You can't say that having higher account receivable turnover is the best. You can't tell that. It's better to have it, but too much higher, better turnover will reduce your market because the customers may lose your company. They will select another competitive supplier. Keep in mind. Right? So those are the things behind the account receivable turnover ratio. What else? Yeah. Account receivable turnover in a hotel company. Hotel account receivable. දෙන්න පුළුවන් නේ. ඒක guest ledger එක වෙන්න පුළුවන්. Travel ledger එකට take and receivable එක වෙන්න. Right? If it is a hospital or something like that, you may have better balance. That really reflect the insurance company data. Otherwise, in a hospital, once you are getting discharged, I think you have to settle the bills. It means you don't have credit services. But credit operations, credit payments, credit payments, they are not being released. So they don't have credit receivables. Whatever the receivables they do have is neatly. එතකොට හොඳම දේ තමයි. So then one of your colleagues highlighting. If you are comparing the return ratio with a hotel, with a manufacturing company, or hotel like a manufacturing company, they want hotel like it's ready. They are not promoting credit sales. Right? So they don't have kind of a guest ledger, high guest ledger balance. Guest ledger can be better. Guest ledger can in a hotel company. We have two different ledger receivable accounts, guest ledger and the agent's receivable account. Those are the two accounts. Common accounts, if you are auditing, if you are going through a hotel account set, receivable containing two parts, guest ledger and the travel agents. Guest ledger means, as at the reporting date, whatever the guest who are accommodating in the hotel, till they are staying, will take some other period to discharge, take out. That's what කියන එක. ඒ කියන්නේ වාගේ 31st December නම් year එක 31st December නම් year එක 25th වගේ ඉඳලා 25th December ආපු ගෙස්ලා එයා ඉන්නවනම් January 15 වෙනකම්. January 15 වෙනකම් ඉන්නවනම් so then 25th to 31st December, 25th to 31st December, you have earned the revenue, right? Revenue credit, debit to guest ledger account, guest ledger. And remaining part will transfer to the next year. So the once they are discharging, checking out from the hotel, they will settle this. So it's a kind of a very short-term receivable account, very minimal balance here. And travel agent also same. So then, as a hotel company, the receivable balance, debtor balance may be not a higher balance, to compare with the manufacturing company, right? And if you are comparing like a wholesale company to retail company, Steel Super is a retail company. But Steel Super is all I know that 9 Steel 9 lower customer. Steel 9 equal ratio wholesale seller. Wholesale seller, they are giving kind of credit period like 60 days, maybe 20 days, right? Depends on the nation. So then, once you are comparing this ratio, keep in mind you need to have proper understanding about the credit policy of that organization. Credit policy. So then, once you are doing your group activity, you are selecting industry. Within the industry also, some companies, in between some companies, their credit policy may vary. Accordingly, your ratio also reflecting different perspective. If once you are presenting, if I am asking question within the industry, what is the reason for getting two different answers? Your answer should be the company A differs with the company B according to these credit terms. They are giving 60 days credit period, but B company giving only 15 days credit period. Because of that, they are having low receivable turnover, but in sales side, the company who are giving more than 60 days credit period, they are having more sales. Why? Credit worthy customers going to that organization. That reflection should be there after your full side. Right? Overall understanding should be there. Right. Okay. That's about account receivable turnover ratio. So last sentence. This is a particularly true if we find that account receivables are increasing faster than sales over a prolonged period. So then if we are having less number, a small number for this ratio, it means that your cash collection is very low. Recovery is very low. Right? Recovery is very low means your receivable balance getting higher, increasing. So then your receivable increasing rate is lesser than the sales increasing rate at prolonged time. Prolonged substantial period of time. Prolonged, we had a definition in LKS 39, previous standard. If you are having prolonged period decrease of the market value of the asset, definitely you have to make a provision. Prolonged period. Prolonged period. Prolonged means maybe 3 years, 2 years, right? The long run, you are having kind of a substantial trend of having higher asset turnover ratio. And in comparison to the sales improvement, we are having higher asset turnover, maybe good. If you are having lesser asset turnover, maybe difficult period for that particular entity. That's all about liquidity. Right? So this type of analysis should be there in your mind. And they are moving to credit turnover. And parallelly, we can calculate receivable settlement period. Receivable settlement period. Creditor settlement period. Sorry, debtor settlement period. How we are going to calculate that? In other words, receivable collection period. receivable collection period. If you are having receivable turnover one, receivable turnover one, it means whatever the credit sales you sold, still you have not received cash, right? And then, in other words, receivable collection period is 365 days, right? 365 days divided by 1. This is the recovery period. The recovery period. Right, we are moving to receivable collection period done. Yeah, receivable collection period, simple, right? Whatever the receivable collection terms, right? So then we calculated debtor turnover ratio. It means that what's the frequency, what's the terms you are selling, you are covering your debtor balance within a year. If it is kind of answer 2, you mean that within a year, as per our debtor balance, you are having credit sales 2 times. It means your creditor settlement period is like 365 divided by 2. Divided by 2. If it is answer 1 means your debtor collection period is 365. From that onwards, you can think. If you are having like 10 debtor collection period, 10 means 36.5. Within 36.5 days, you are collecting debtors. Right? You are collecting debtors. If you are going to reduce that, you can get 20, 10, 1. It means that if you are seeing kind of a reducing method, you are giving very less credit period. That's why we told that if you are significantly getting higher value, for cash collection period, your asset turnover ratio getting too much higher. It may be 100, it may be 150, it may be 200, right? If you are getting asset turnover 200, 365 divided by 200, it means within 1.5, you are getting higher, too much higher. Receivable turnover ratio means your credit terms getting decreased. So then you are in a credit worthy market. That means you are looking at your prior customers will be catched by other capital. Right? So then you need to balance that. Your credit period versus sales. Right. Okay, we are moving to creditor turnover. Creditor turnover. Creditor turnover ratio. Same way, creditor turnover ratio, credit purchases divided by average creditor. Credit purchases divided by average creditor. So then again, credit purchases for the period concept, average creditor balance sheet items, we are getting average amount because of that. It assumes that that average creditor will remain for the period as a creditor balance. If we are having that much of creditor, how frequently we are settling our creditor balance, that will reflect creditor turnover ratio. So what is the target? To have higher value. To have higher value. Why? That is healthy to manage liquidity. We are trying to have higher value. But we are not promoting to have ultimate higher values. Why? It means you are delaying to pay your creditors, your vendors. Then you are losing your good vendors. Right? So then you need to focus that. We can say that lesser is generally better, but too less might indicate that the firm is denied to make settlement for creditors. Too less, smaller values may not be the best target. You need to manage it because your vendors also critical part of your business. To have kind of a quick operating cycle, your vendors are giving kind of a good contribution. Why? If they are getting delay to supply, definitely this operating cycle will get delay, right? If you are getting delay to pay, definitely they are not providing whatever the items on time. They are also making some delays. අපෝ එයා ගෙවන්නේ අපි ඉන්වෙන්ටරි යවනකොට පොඩ්ඩක් ඇදලා යවමු. මොකද සල්ලි හම්බෙන්නේ නැහැ නේ කියලා කියනවා. So then if you are doing kind of a proper relationship and if you can settle that, so then they are also proactive to supply, right? Basically, that's kind of a win-win situation. We need to manage that. We need to have kind of a period, let's say 30 days, 45 days. As at that day, you need to settle it. If you are getting too late, will create another pressure, right? We will lose quality suppliers. We will lose kind of prominent supplier in the market. Suppliers also are active in the market, right? Customers. We can collect customers through marketing. It's really difficult to have kind of a good supplier from the market. Really difficult, right? Understanding quality and relationship really important. So then, to have healthy asset turnover, will create type of a strong relationship with the debtors and vendors. That's really important as an organization, right? Okay, then again by using this, we can calculate creditor settlement period, receivable collection period, and creditor settlement period. If you have type of a, let's say, 10 frequency, it means for 365 days, you are settling, you are taking 36 days to settle one creditor. That means creditor settlement period. Creditor settlement period, let's say 20. What it means to you? Within 20 days, you can get cash from that organization in average. That's the real answer. If you are getting like 1 for asset turnover, creditor turnover, you have to 365 divided 1. So then that organization will take 365 days. How would that settle? So then you are not going to tie up with this company. Right? So that's a basic understanding. Accordingly, you can calculate cash cycle. See? Cash conversion cycle. Cash conversion cycle means ISP plus RCP minus TPSP. One are they? Inventory holding period and receivable collection period and creditor settlement period. First two items plus. First two items plus. Second item minus. Altogether, we are saying that cash conversion cycle. First two, we are trying to increase always. Third one, we are trying to decrease. And the asset creditor turnover, debtor turnover, and then inventory turnover. We want to inventory turnover and debtor turnover, we want to have higher value. Credit turnover, we want to have lesser value. Right. So then that logic will impact to the cash cycle. Cash cycle එක වැඩි වෙන්නද ඕන අඩු වෙන්නද ඕන? 50, 30. What's the positive figure? 50 or 30? 30 is the positive figure. Within shorter period, cash will convert. Right? Debtor will convert to cash. Creditor will convert to cash. Right. Before we are going to this ratio, leverage ratios, we have another two efficiency ratios. What are they? Total asset turnover ratio. Total asset turnover ratio. Also a ratio we can't compare with most of the industries, right? We can compare with the hotel with the kind of a virtual business. It's difficult to compare sales versus total assets. Total assets. Sales divided by total assets. We can say that average total assets. Average total assets. Why? Again, sales is for the period concept, total assets is the balance sheet item. So the total assets we have taken here assumption that total assets is a average figure for the year. If we have fluctuation, we have to get the average total assets. So opening total asset plus year-end total asset divided by 2 should be the ideal number, right? We can interpret the asset turnover ratio as follows. Higher is better. However, we should be aware that some industries will naturally have lower turnover ratio than others. What are the type of companies? Let's say hotel. Because hotel asset, the building, will be included to the total asset. Because local value. So the useful life may be more than 50, 60 years, that will be included the total assets. If you are comparing that with the kind of a service rendering company, like Uber, PicMe, so whatever the sales is done by PicMe, we are comparing with the hotel. So then you are getting kind of a two different answers, right? PicMe may not have much assets, only the capitalized software, head office building, and they do sales. So the very minimal assets base. But as a hotel, as a manufacturing company, they may have large amount of fixed assets, right? Other thing is the telecommunication industry. In the mobile dialogue, that's the normal. Yeah, again, PP antivirus, hours and one again, there's like a whole chicken router. Yeah, PP anti. Then, while I'm going to get it, AK आगे दूसरा you know PP anti. So they are having significant asset value. That asset balance versus sales. वाला cables use कर लेते हैं. Sales cables use कर लेते हैं. The cables लेकर आने. Then they have invested more money, right? So they are useful life maybe more than 60-40 years. It means that your asset turnover may be very less amount. So then be careful once you are comparing that asset with the other industry. You need to focus that. The comparison purpose, if you are using asset turnover ratio, the basis should be evaluated. As I said previously, let's assume that one company using evaluation model, other company using cost model. Cost model use करने का क्या asset figure काटूँगा. Evaluation model use करना asset value का थोड़ा बढ़ेगी. So then you are getting less turnover. So then before after you are comparing that asset turnover value, you need to ensure that the property, plant and equipment asset evaluation model, right? इधर किसी दिया तुमने करो इधर कमांड है बताओ क्या डिटेल तो मिलता है वो लोग कहाँ से इधर ऐसा प्रोडक्ट इस तरह है लिखता अरे को दिया नहीं था मास्टर की मस्त प्रोडक्ट नाम नहीं लाइट के नाम से तो आपसे इतना इधर में दिया होगी दागे ने लोग ये रहा प्रोग्राम इतने बुरा है दागे दिया okay so the efficiency ratio almost done thus these two ratios are very common, gross margin and the profitability ratio. Gross margin and profitability and profit and gross margin. Gross margin, really important ratio. Sales, profit, gross margin. We don't need to get any average here. Both are from P&L. Gross profit and sales. Gross profit and sales. Gross margin is a good indication in the industry to understand the core business profitability, right? Gross margin is the indicator of a industry. The profitability indicator, gross margin. The very powerful ratio to get decisions. Once you are getting decision, first question you are asking, what's the margin? What's the margin mean? Whatever the key sales, co-operational sales deducted by whatever the cost of sales and show it as a percentage gross margin, right? Basically, gross margin is a percentage we have to service for over OD, that whatever the admin cost and the profitability. Gross margin and then EBIT, EBITDA, yes. Gross margin के कारण के ඊට පස්සේ අපි Other expenses. EBIT के लिए क्या है? Operational profit. Earning before interest and tax. EBIT वाले कितना है कि ना operational profit. Gross profit versus operational. Once you are calculating operational profit, from the gross profit, you need to deduct whatever the admin related expense. Then only you are getting EBIT. EBIT means tax secretary, interest secretary, profit. That's the operational profit. As operation, what's the profit? As a sales, as a core business, what's the profit? 50%. Your EBIT may be 30%. 30%. Right? Okay. So then gross margin and the operating profit margin and net profit margin. Operating profit margin means sales net profit income divided by net operating profit income divided by sales, and net profit margin means net profit margin, net profit divided by sales. So then those are very familiar ratios, right? So then after this, we'll go to a question. You can do calculation. I have uploaded to the LMS. Question number 1. Not question number 1. Question number 2. You can try. This question. Can you all quickly do this? So it should calculate net profit ratio, debt collection, quick asset ratio, inventory turnover, period debt equity ratio, earning per share. So you are doing. මොනවාගේ ඩවුන්ලෝඩ් කරලා කෙනෙක් ෂෙයා කරන්න පුළුවන් ගෲප් එකට. ඒකට WhatsApp login තමයි තියෙන්නේ. WhatsApp එක ඇප් එකක් තියෙනවා මේකේ මේ ඒක ඇප් ස්ටෝර් එකේ ඩවුන්ලෝඩ් කරගෙන ඒක Number 2. So the net profit ratio, how much? Right. And debt collection period? 81 days. So then we have Then big ratio you have to remove inventory, right? Remove inventory means you don't need to calculate the current asset. Whatever the available liquid asset you can add. Here we have debtor and the cash. Data and the cash divided by current liabilities. So then the other way around, you can do calculate current asset, remove inventory, remove prepaid expenses, divided by current liability. We can use cash plus debtor. You don't need to calculate the current asset. Right? You calculate the current asset. It will include cash, debtor, inventory, prepaid expenses. So then, after adding those things, you want to make inventory and prepaid expenses. It means that you are adding in debtor and cash. Debtor plus cash divided by So the number of shares should be included to the question. So then as at date, you can put that within bracket and say 180,000 shares. So then that should be included. Then that should be included to the question. What we did, 180,000 shares. 180,000 shares. You can put a bracket here. So then this is the number equity plus capital that was included 180,000 shares. Right. So then I calculated 4 ratios. I hope that you are comfortable to calculate inventory, turnover, and debt equity ratio. Right. We are moving to some other ratios. We need to discuss capital market ratios and some other gearing ratios. Right. How about this company? Company How about this company? Indian company, right? Right. But you can think about this company overall. So then calculating these numbers may be kind of a simple process. You need to have overall understanding. That's why machine එකක් So then what do you think about this company? That's the important part. So then here we have 25% gross margin. 25% gross margin, 7.5% net margin, right? You can compare with the market interest rate. Interest rate, how much? 22%. So the interest rate again. How you can get the interest rate? You have interest expense. Interest expense divided by long-term loan. You have 22%. ඒක හදන්න කියලාද තියෙන්නේ? ඒක හදන්න කියලා නැහැ. So then once you are comparing your profitability versus net profit versus tax expense. Comparing a very difficult situation. Why? You are earning your net profit 7.5%. You have to pay 22% interest. Right? 22% interest. Earning before interest tax ratio. Earning before interest tax ratio. Calculate. You can calculate that. 15%. Operating profit 15%. Operating profit 15%. How we are getting that? Gross margin deduct. You can deduct operating expense from the gross margin divided by sales. You are getting 15%. So then you are earning 15%. You have to pay 25%, 22% interest during the year. So as a company, your earnings should be higher than this. You are in a very difficult situation to service the loan. Right? Quick ratio per se, you are okay. Your liquidity okay. And your asset debt collection period should be higher. Efficiency should be your debt collection period should be better. It should be less than this, not 60 days, it should be like 30 days. Your asset debtor turnover should be higher than this. So then it means that company is not in a good position. That overall understanding you can link with the inventory turnover ratio as well as the debt to equity ratio. Debt to equity ratio, yes, you can compare long-term loan versus total equity. Ratio is much higher, 81 to 54. Total equity 81 million. Total debt, long-term debt 54 million. Ratio-wise, too much high. To maintain that gearing ratio with 22% interest, every year you have to earn much more than this 25% margin. 25% margin not adequate to service this. Why? 25% margin is there. You are paying 22% interest. How you can accommodate that interest? I'm getting what I'm telling you. Straight away you can see gross margin 25%. What becomes 22% interest rate. So gross margin 25% is better. But can be very dangerous. So then that's what you have to mention. So in the exam, you have to tell that. So then in the exam, I have given 15 marks for this question. 15 marks, 5 marks for calculation. higher ratios, 10 marks for explanation. Keep in mind, explanation is the critical part. ඒක තමයි note එකක් ගන්න ලියාගන්න ඕනේ. ඒ කියන්නේ ratios ලියලා calculation එක නෙවෙයි. Explanation, interpretation, the conclusion about the concept. Conclusion you can give kind of area wise, liquidity, profitability, gearing. Likewise, you can give right efficiency, all those things to be linked. If you have efficiency, definitely it will link to the profitability. That will link to the gearing. That will link to the other capital market rates we need to discuss. Right? Okay then. Yeah, moving to yes. Okay. So then this interest expense not 22%, right? It's 11%. I have taken the operating expense, right? So there is 6% of 6,000. If it is 11%, whole equation may be changed. 11% may be healthy. 11%, 25%. Compare that, right? So then I base out 22%. 22% I erroneously calculated is I got 12,000. Yeah, I got that operating expense as interest rate. That is from the measure 6,000. 6,000 divided by 4,000. 6,000 divided by 4,000. So then 6,000 divided by 54,000. That's the interest rate, market interest, 11%. If you are having market rate 11%, 11% company may be average. Why? We are earning 25% margin. We have a buffer. We have a buffer for taxes, admin costs and interest. We are in a kind of a sales situation. We are having one quick ratio. So then company is average level. Not the extreme good, not worse. Company is average position. Likewise, you can calculate and give a kind of a conclusion. The area-wise conclusion, overall conclusion, whether it's a high situation, moderate, or lower situation. And the terminology you can use. Company in a very crucial situation or performing good, and it's a kind of a expanding company. Likewise, you can comment about the company situation. Right. Here we are looking leverage ratios, right? Leverage ratio. Leverage ratio. By using the leverage ratios, right? Are we using external debt for our financing? That's all about leverage. Are you going to leverage the company? Leverage ratio. It means the ratio in between debt and the capital. What's your view? Are you going to leverage the company? What debt capital is the company? How are you going to decide that? Whether you are going to leverage the company, it means are you going to with some of the debt financing or loan become done over the company. To that, what you have to decide what's your margin and the operating cost. If you are having good margin, operating profit, so the my suggestion is you can go to a loan, right? So then loan may be very less cost. Once you are earning more than 40%, let's say, gross margin, then even like 12%, 17%, you can give the interest. The remaining part, what you can do, the others cash can be used for your company. That's how you can expand businesses, right? So then if you do profitable business, bank will support you, arrange cash. Then bank is profitable when you go. Bank is profitable when you go. So you are bank is not profitable when what profitable when? Or the margin is the other. The bank is a margin in the deposit FD versus loan rate gap. FD rate may be 8%, loan rate may be 15%, 7% for their income, right? So then 7% income they generate, and you are giving 17%. You are giving 15% to them. Why? You are earning more than that. Let's say you are earning 25. So then you are keeping like 10%, 25%, 10%, 15% you give to bank. Bank keeping another 7%, they will give to the FD holders another like 8%. That's the equation. The deposit holders, they don't have intention to start businesses. They don't have time and the capability and intent to start a business. So they may be in a kind of a age life or kind of a person who is average. They are not going to start any business. So then what they have to do? They are starting with this, they are not bad. They are big investors. So then they are enjoying their money by getting 8% interest. Bank what they are doing? For 8% they are getting FD. They are giving 17%. Up to the trend. 17% loan again. We are earning 25%. So then we have a margin. Bank also have a margin. The person who invested in FD, they have a kind of a reasonable interest, like 8%. That's the cycle in the financial market. Right? Financial general market. So then we have in the financial market, we have different transactions, right? Share transaction, derivative, and then overnight repos, treasury bill, treasury bond, commercial papers, debentures. We have different instruments. All the instruments, the parties who are spending, investing, and they should have return. Then government is bill bond issue කරලා එයා earn කරලා ඒකයි start කරන්නේ. So then if they are issuing treasury bill bond like 8% or 9% rate, they have to earn more than that. If they are using that for government consumption, definitely they will start in some position. That's what we are suffering is this local and foreign debts as a bank. So whatever the rates we are paying, we are not earning as a government. And we should have a real earning more than the interest rate. As an organization, that's relevant for that organization as well. So that's why we are telling that we need to have kind of a moderate leverage as a company. It can't be 50-50, it can't be 30-50. We are not recommending to have 70-30, 70 30 50. The high risk position, you need to have continuous profitability. We are having that type of leverage. Right? So the leverage can be measured by using different ratios. That may be debt to equity ratio, or then total asset to debt ratio. Different ratios are there. Total debt, total assets, and total long-term debt ratio. Total long-term debt divided by total assets. If it is 1, what does it mean to you? Theorem asset, debt වලින් තමයි finance කරන් තියෙන්නේ කියලා. 1 වෙන්න බෑ නේද? So then maybe 50%. 50% mean total asset was invested by you and 50% from the debt finance. Then debt to equity ratio, total asset to equity ratio, debt to equity ratio, 1 to 1. If you are having like 50% total asset ratio, it means in other terms, total debt to equity ratio 1 to 1. Right? කියන එක තේරෙනවද? මම explain කරන්න නැති තේරෙනවා කියන එක. Total asset to you know that, right? You learn this from the police school. Total asset equal capital plus long term or liability, let's say. Liability is the counting equation you learn at the preschool, right? Total asset to liability ratio. If it is 50%, it says that your total asset 100, your capital 50, your liability 50. Simple, right? If you have 50% total debt to equity, total asset ratio, this one, total debt ratio, it means that debt to equity ratio 50 to 50. It means 1 to 1. Simple, right? So then here we have another ratio, very important ratio, interest cover ratio. Interest cover as a investor, as a investor to the they are earning interest for their capital, for their loan balance. They are earning the interest, right? This interest should be covered through profitability. So then we need to earn profit to service this interest. Through this ratio, what we are going to do, we need to measure that. What the frequency, what the terms, what the coverage we have as entity for interest, right? We have interest amount. Let's say we have operating profit. Yeah, operating profit. This much, 100. Your interest 10. Operating profit 100, interest 10. You have 10 times recover kind of a safety. 10 times. So why we are not getting profit after tax? We are getting earning before interest tax. Why? This ratio will be calculated with the perspective of debt holders, investors, right? Investors looking at our company, they are focusing about only EBIT, earning before interest and tax. Why? If you calculate profit after tax, we have already deducted this interest from this. So then we know so then we can't calculate then the exact coverage. So then through this ratio, what we are going to get, how safety we have as a debt holder. But the frequency they are earning to give this interest. What are the earnings they have to provide to service this interest? So then for that, we need to calculate earning. This earning for whom? This earnings to whom? To debt holders as well as to the shareholders. Both investors earning is the EBIT. EBIT for debt holders and equity holders. That's the operational profit. So then that will be divided by interest expense. Then that will reflect how frequency we have as an organization to service your debt reward. Debt reward means, in other terms, that's called interest. Right? Interest will be covered 10 times to the profit. That's the logic you have. That should be a higher value always. මෙහෙම කිව්වොත් වාගේ profit එක operating profit 90 වාගේ interest එක 90 ඒක මොකද කියන්නේ පාට එක පහරයි නේ ගෙවු ගම net මොනවාද profit after tax 0. So then you need to focus that. That's all about times interest cover ratio. The basic ratio, this is not a kind of a popular ratio to discuss. Yeah. So then we have some other profitability ratio, return on asset, return on equity, return on asset, return on equity. So the return on equity, really important. Return on equity. That's the ratio we are calculating. In other terms, we can say that return on equity, the meaning, very similar with the earning per share. Earning per share, return on equity. Earning per share may be kind of a number, LKR amount. Return on equity may be a percentage. That's only different, right? That's only different. Return on equity, AE. Return on equity. What was the calculation? Net profit after tax divided by total equity. Total equity equal capital plus retained earnings. This is called return on equity. Return on equity. ROE. Return on equity වලට තව විදියක් කියනවා නේද? AE කිය. Return on equity equal risk-free rate. Risk-free rate plus beta factor. Beta factor into what? Market premium. මේක දන්නවනේ. මේ formula. So then, how you are calculating return, your return on equity according to the CAPM model. CAPM model, we are calculating risk-free rate plus beta factor into market premium. Market risk premium. Market risk premium. Market risk premium equal market rate minus risk-free rate. එහෙනම් මොකද? Equation එක. Market rate minus risk-free rate into beta factor plus risk-free rate equal to KE, return on equity. මේක තේරෙන්නේ නැත්නම් ප්‍රශ්නයක්. This should be in your head. Return on equity. Why? As a company, this is the risk-free rate in the market. That's what I discussed today morning. You can link with this. This is the risk-free rate in the market. ඒක මොකක්ද කීය විතර වෙන්නේ නැද්ද දැන්? දැන් අපි හිතමුකෝ 6% කියලා. 6%. So then here what we have. මේ වාගේ කම්පැනි එකේ අයිතිකාරයෝ earn කරන සල්ලි ගන්න. Expect කරන ගන්න. වා business එකක් කරනවා නම් this is what you expecting. Return on equity. Return on equity. Right? ඒක කීය වෙන්න ඕන කියලාද මම කිව්වේ? ඒක market borrowing rate වලට වඩා වැඩි වෙන්න ඕන. Why? Market borrowing rate holders, they are getting that return for finance risk only. You are getting finance risk plus the business risk. For this KE, for the reward of finance risk plus the business risk. That should be more than loan borrowing interest rate. That's obvious, right? So then how are you going to calculate it? Make a accounting සම්බන්ධ නැහැ. It's all about financial management, right? Risk-free rate plus beta factor. What do you mean by this? Beta factor. What is the risk factor for your companion? That's called beta factor. Then the risk. The risk is a deviation from the expectation. If someone invests in your organization, this is the specific risk calculated for my organization. That's called beta factor. Right? What is this? Risk premium. Risk premium. Market rate Market rate. Market rate means whatever the industry you are going to invest as a market, what's the rate you are earning? Market. So then in the market, you may have many players. In the industry, you may have many players. As a hotel industry, what is the margin? What's the return you are earning? Right? As a hotel industry, what's the margin you are earning? So then you are deducting risk free rate. Let's say as a hotel industry, you are earning 40%. 40% market rate. As a hotel industry. In hotel industry, you have many players, right? So then market rate 6%. You are deducting 6%. So then you are getting 34%. What is that? What is that? Market premium. Market premium. From by heart, you need to learn this. This is market premium. Once you are investing in hotel industry, you are earning premium 34%. Right? This is the hotel industry premium. From the hotel industry, you are a one player. You are a one player. You are one company, one hotel. So with comparing to the industry, how about yours? It should be more than one. Industry beta factor here. Industry beta factor always one. To the industry. Industry wow, one player can it now. Yours may be high. Why? Industry is the bully country or the bully country? What are we bully country? What bully country no? Industry country, bully country no. Industry country. Industry के पीए ने बोलो, what bully country? ऐसा industry की industry में तो बड़ा return देखा, इससे का पीए तो पानी invest करेगी। ये तो दे You need to get what I'm telling. So then you have money, 10 million money. You are going to invest in kind of a 10 hotels. Wow, 10 million money, 1 million, 1 million, 10 hotels invest. So what is the risk? If you are investing 10 million in one particular company, one particular hotel, so then you expect more than that return. So then this is kind of a beta factor. Beta factor may be like 2.6, maybe let's say that 1.5 beta factor. So then 34% into 1.5 is your company premium. Company premium. Right? And then need to plus with the risk-free rate. That is the expected rate of return for the equity holders. Right. You need to know what it is. 1.5. Why calculate the stock market company profile beta factor. Beta factor එකක් තියෙනවා. company එකේ players ලා නැහැ. ඔයා විතරයි ඉන්නේ. එහෙනම් මොකද වෙන්නේ? ඔයාගේ beta factor එක market එකේ beta factor එකට equal. එහෙනම් 1. ඔයා railway market එක ගත්තොත් players එක්කේ නැහැ. train income. players market එකේ එක්කේ නැහැ, industry එකේ එක්කේ නැහැ. එහෙමනම් මොකද්ද? මෙතන impact is 1. Market return equal to the KE, expected return. Market return equal to the KE. So then that's about return on equity. Return on equity. Whatever the question you are getting, return on equity, please compare with the interest rate and risk rate. Then you can have kind of understanding about the company earning money. So that's my reason. Yes. Capital model is from Lanka model. Financial ratios are from Lanka. Capital model, I will share some slide about capital model. You can see how we are going to calculate return on equity. Then we have that. These terminologies can take on this, financial management. So then, how we are going to calculate T. So then, return on equity, return on debt, return on equity, return on debt. By using the average, we can calculate weighted average cost of capital. Weighted average cost of capital should be used for your financial appraisal, investment appraisal. Whatever the investment you are going to do, you need to evaluate by using that WACC, weighted average cost of capital. So then, to weighted average cost of capital equal KE into percentage plus KT into percentage weighted average cost of capital. So then that should be used for your NPV calculation. Once you are calculating cost of weighted average cost of capital, the NPV zero rate you call IRR, internal rate of return. Right? That is called the real income rate for the project. If WACC equal to IRR, common. WACC equal to IRR කියන්නේ මොකක්ද? සාමාන්‍යයෙන් සැතපිලා ඉන්න පුළුවන්. ඒ කියන්නේ හොඳට තේරෙන්න ඕනේ මේවා. ආයේ මේ ආවට ගියාට මේ WACC දවුණු වචනයක් එහෙම නැහැ. Return on equity අයිතිකාරයන්ට ඕන ගන්න. Return on debt average කරලා ගත්තම මොන රේෂියෝ එක. ඒක ප්‍රොජෙක්ට් එකේ NPV 0 වෙන රේට් එකේ වැලියු එක. NPV 0 තේරම රිටර්න් එක සේරම කැෂ් ෆ්ලෝ දාලා හදන රේට් එක බිඳුව වෙයි. තේරම අයිතිකාරයන්ට සීලා තේරම දීලා කැෂ් ෆ්ලෝ ප්‍රොජෙක්ෂන් එක බලලා ඉවර වුණාම ඩිවිඩන්ඩ් තු දීලා ඉවර වුණාම ප්‍රොජෙක්ට් එක 0 equal to IRR. කියන්නේ ප්‍රොජෙක්ට් එක 0 වෙන රේට් එක. That equal to this. It means that project is viable. If IRR less than and higher than that, you can decide whether you are going to do this investment or not. Make a වැඩි වෙනවද මේක අඩු වෙනවද මම decide කරන්න ඕනේ මේ WACC එක service කරන්න පුළුවන් දෙයක්. මේ expect කරන දේ දෙන්න පුළුවන්. That's how you have to do investment appraisal. That's about finance management, right? Right. මෙහෙම FM කරා නම් හරිද? FM තමයි මම හොඳටම දන්නේ. මොකද chartered FM paper එක හතර පාරක්. ඒ තමයි Colombo paper එක type plan. දැන් FM හොඳට දන්න. ඒකට උගන්වන්න කියලා දැන් ගිහිල්ලා තේරුණා. FM paper එක තමයි මේ මොනවා කියන්නේ? Monitoring, financial reporting, consolidation, nothing. Then, in advance, finance management. The question we are getting, we can expect We can assume that finance management is for me it's difficult, but after passing the exam, it is the most interesting subject. Finance management. So then, whatever the area, they are focusing this capital theory, embedded theory, we have different aspects. Then you have to focus that area, think from finance management. Right. We are moving forward and we have remaining market related ratios. Quickly we can go to that. Yes, we need to go to the next session, next area. Next session about other financial analytics. Right, capital market ratios. Capital market ratios. Capital market ratios. We have this current ratio, efficiency ratio, and leverage ratio. All are relating to the financial historical accounting numbers. So here we are discussing about capital market related ratios, right? So then we are focusing about earning per share, and then dividend per share, earning yield, and dividend yield, and then PE ratio. We need to calculate PE ratio as well. Yeah, PE ratio and dividend payout ratio. You should know that in financial accounting, we are using historical numbers. So then, basically the book value. For that, we are using standards. In case SLFRS is the value. But once you are going to the market, let's say stock exchange, so you are selling stocks. The market value may be different. Market value may be different. For as at the date, to an entity, you may have book value and the market value. Book value and the market value. Book value may reflect through your financial statements. Market value won't be reflected in your financial statements, right? Market value. Some of the area like historical accounting also change into some of the market prices, right? That's why you do revaluation for PP&E. You are using fair value for biological asset. You are using some not totally depend on historical numbers. You are getting fair value related numbers as well. Keep in mind. But still historical accounting, the market value of the company may differ. Sometimes market value may be lesser than the historical number, sometimes it may be higher. Most of the cases, market value is a higher value. Book value is a lesser value. The reason is, for the book value, we are not getting some of the fair values, some of the internally generated goodwill and brand values. All those things we are not going to capitalize. Right? Whatever the intellectual things. Right? Qualitative aspects. But here, market value reflects all those things. Market value can be not. shares issue කරලා තියෙනවා, let's say 500 shares we have invested in the market. We have like 250 shareholders. 250 shareholders, they are selling these shares during the market. In the market, right? During the period, they are selling that. The selling price of the shares reflect your market value. So that selling price won't be reflected in the books historical numbers. But the selling price will be decided by the investors based on the historical numbers. Historical number reflects the performance of the organization. Based on that, these prices may be higher values. So then earning per share 2023 to 2024 increase 10 to 15. This is a kind of indication to the market. Then the share prices will go up. So then investors who are investing in shares in a company, they look at their financials, not only 1 year. That's why we are giving 10-year summary financials in an annual report. It's a compulsory disclosure. For annual report, company with a 10-year financial skill. So then, if you are kind of a good, person having good, that analytical skill, within which having kind of basic accounting sense, you don't want kind of a private dealer to invest in stock market. What you can do is yourself you can evaluate and you can invest in stock market simply. So then you can evaluate 10-year summary, calculate some of the ratios, you can see what's close. Then the water balance sheet can follow company as you did in the last question. So likewise, you have 10 years now. So then for 10 years, you can check that. 10 years, you can, check the trend of, efficiency, volatility, and then type of leverage and other aspects like profitability. All those things can be evaluated for the last 10 years. After evaluating these aspects, you can simply decide whether you are going to invest it or not. So then, accordingly, to take the decisions, we have some of the ratios. What are they? That is called capital market related ratios. People who are going to invest, they calculate these ratios and they are taking their decision. That's why we are telling that capital market related ratios. Right? So the one is earning per share. අමාරු calculation එක ඒක මම කරන්න ප්‍රයත්න කරන්නේ නැහැ. ඇයි? අපි ස්ටෑන්ඩඩ් එකක් එක්ක සම්පූර්ණයෙන්ම දැනට ඉගෙනගෙන තියෙනවා. ඒක already have done it. අමතක නම් මේ last year lecture එක බලනවා නම් last week එකේ lecture එක බලනවා නම් earning per share we have done. Because it's a complex calculation. We have a standard related to this. So then, for the DPS, we don't have a standard. Earning per share, we had this standard. We have covered it. Same way, earning per share is the earning per share, right? There's nothing more than that. Earning divided by weighted average number of shares, right? And then dividend per share. Always dividend per share. Most of the cases, earning per share is a higher value compared to dividend per share. Why? Most of the companies, they are not distributing all earnings to the shareholders. Why? They are keeping some of the investments for their internal purpose. That's why they are having return earnings. That's why they are having return earnings. Right? Some instance, earning per share that for that period may be lesser than the DPS. Earnings per share එක අඩුයි. dividend per share එකට වඩා. වෙන්න පුළුවන්. හා? earnings per share versus dividend per share. Yes, possible. Your parents can release their dividends. Let's say last 5 years, they have not declared dividends. They have more return earnings. They are planning to declare some dividends more than earnings per share. That is possible. For last 5 years, we have not declared dividends. This time we are declaring dividends more than earnings per share. Why? We do have some of the accumulated profit. We are declaring dividend more than the earnings per share. Right? There may be a possibility. But most of the cases, earnings per share is a higher value compared to the dividend per share. Right? Earning yield. Earning yield means EPS divided by market share. Market share price. Let's say your share price 100. Your earning per share 20. Your yield 20%. Your yield means market yield means your return rate per 100 invest करो 120 earn करो. Market yield, market return, right? So then dividend yield 100 invest करो और dividend विजेता 15 हम बना. Dividend yield, real earning, real dividend rate, right? And then you are moving to price earning ratio. Price earning ratio. That's called PE ratio. PE ratio is the most important ratio. PE ratio can be used for your business valuations. PE ratio. Price earning ratio. And this will reflect market value per share divided by EPS. Market value per share divided by EPS. PE ratio can be used for your business valuation. How are you going to do that? Let's say you want to value two different companies. Let's say two hotels, A, B. A hotel, B hotel. A is a listed company. PLC, this is not a listed company. They come from hotels later. So then what you're going to do is you want to value this listed company. Or let's say both. Once you are doing your valuation, what's the steps you can do? PLC, straightforward. Why? You have a market, you have identical share prices. What you can do is, you can go to the Colombo Stock Exchange, check the share price into number of shares. That's the market value. Market value of the shares plus equity debt value. That's the total value of the entity. Total value of the entity. So then how are we going to value this company? Value of this company. You can't get that identical share price. Then what you have to do? What you can do is, here we have market value. Market value per share. This company. They are having EPS. EPS. So then we calculate PE ratio. PE ratio for a company. We assume that PE ratio will reflect in the B company. That's the assumption we are putting. That PE ratio will reflect in the B company. So then you may have argument why two different companies, how you assume that kind of a repeat result for two different companies. ඔයාගේ යාළුවට හම්බෙන්නේ exam එකේ එක result එකක් ඔයාට හම්බෙන්නේ එක result එකක්. දෙන්නම එක වගේ. ඒක විදිහටම අඳින්නේ. එහෙම කියන්න බෑ. ඔයාට මේකේ එන්නේ නැහැ කියලා කියනවා. මොකද two different location, two different brand name, two different kind of structure in the hotel, right? But same rating, like 5 star, 5 star. There's a similarity, like 5-star hotel, but the brand image and so then some of the things, foods per se, this company is very popular. The facility per se, this hotel is very popular. Or then cinnamon lights the neighbors. Per se, tower, hotel, brand එකක් තියෙන්නේ නේ. ඒ නම ගිහිල්ලා නම දාලා දාන්න තමයි කැමතිද? ඔව්. ඒ නමට තියෙන බ්‍රෑන්ඩ් එක private limited listed companies. මොන රේන්ජ් එකේද? අමායා ලෙස රේන්ජ් එකේද නේද? නැත්නම් ජෙට්වින් group එකේද? සිට්‍රස් group එකේද? තව තියෙන hotel chains. Else, we have this cinnamon and there is Marriott and then those are the things come to my mind. Other than we have different luxury hotels in Sri Lanka. So we have Uga, also good. So then different hotels, same rating. So then people like to this brand name. So then there's argument, you can't use same PE ratio. So then what we are going to do? We have a PE ratio. Let's say PE ratio 5 to, let's say 10 to 1, or else we can say that 10%. What we are going to do is we are going to add a loading like 2%, 3% loading for that difference. To that difference, you can add a different loading, right? That's purely judgmental. So then you can calculate PE ratio for this company, private limited company. We calculate PE ratio for the listed company, add a loading, and we have now the PE ratio for this company, right? Then what you're going to do? Can you calculate earning per share of this company? Can you calculate earning per share of this company? Easily can. Why? We have profit after tax divided by weighted average number of shares available. Right? So then we have now EPS. We have EPS. Now we have PE ratio. So then what we want to get? මට දැන් මොකද ඕන වෙන්නේ? ඔයාලට ඕන වෙන්නේ මේකේ දැන් මතක නැහැ අපි මොකද කරන්න යන්නේ කියලා. කම්පැනි දෙක වැලියු කරන්න යන්නේ. ඔයාලට ඕන වෙන්නේ මොකද්ද? කම්පැනි එකේ වැලියු එක ගැන. නේද? මාකට් වැලියු of this company. ඔයාලට ලස්සන මේකක් තියෙනවා මෙතන නේද? ඉක්වේෂන් එක. P ratio equal market value of share divided by EPS. Now you know EPS. Now you know PE ratio. What you can get? Market value of a share of the private limited company. That market value of shares can be multiplied by the number of shares. You are getting market value of this company, right? So then, through this company, you are doing valuation for this company. This type of valuation can be done by using PE ratio. This is about PE ratio based business valuation, right? Then again, this is finance management business valuation, right? This is not relevant for this theoretical aspect, not relevant for this area, but PE ratio calculation highly relevant for this area. Through analytics, to get decisions and maybe shareholder decisions, and then kind of a disposal decision. That decision may be depend on X type of ratio, right? Okay. Right. So then once you are doing your ratio analysis, you can get understanding about the company, about the financial structure and shareholders' perspective, efficiency, and then profitability, and the futuristic solvency aspect, as well as the liquidity aspect, profitability aspect of the company. So then, once you are doing your analytics, don't stop with the number. You need to evaluate the qualitative aspects as well. What are the qualitative aspects you need to focus? What are the qualitative aspects you need to focus? Not only numbers. Your profitability numbers may be really good this year, but the compliance status says that this year onwards, your main operation may be prohibited. If it is so, that should be reflected in your analytics, right? මේ පාර profitable වුණාට in the latest law එකකදී ඔයාගේ business එක illegal business එකක් වෙනවා. So then that's a factor you need to focus. And your numbers, financial figures, not reflect the customer satisfaction. So the brand image and then quality of your service kind of an expansion plan, research and development activities. Those things not be reflected. So then, once you are doing your analytics, these aspects, it may be employee satisfaction. Wow, more profitable entity එකක් කරන්න යන්නේ. හැබැයි employees දෙන්නේ කොහොමද? අඩාගත්ත ගමන් ඉන්නේ නේද? බෝනස් නැහැ. නේද? ඒ යන්නේ තනන අවසෙන් දෙන්න අඩ. එහෙනම් there's no kind of a sustainability. So then, if you are earning some profitability, satisfied employees, kind of a sustainable goal. ඒ employees ලා කොහොමද? ගෙදරට වඩා ඔෆිස් එකට ආදරේ. එහෙනම් කොහොමද? හැමදාම ගෙදර වගේ ඔෆිස් එකේ ඉන්නේ. ගෙදර නැති වෙනවද තමයි ගෙදර. ඒ වගේ ඔෆිස් එකේ නැති වෙනවද කියන්නේ? එහෙනම් හැමදාම ඒවට earn කරයි. So then you should have kind of a employee satisfaction and customer portfolio, product quality, innovations. හැමදාම multi business discuss එකක් වෙනවා නේද? ඒකෙන් කාටද නේද? You part back you part so they are doing innovations. They are releasing some new products to the market. So then, other thing is business reputation, future challenges, and supplier portfolio. That's also really important. If you are depending on 1-2 suppliers, definitely you are in a challenging situation. That should be reflected. If there's a kind of a challenge to one supplier, all operations you may have impacted. So then, careful about the suppliers actually. The quality of suppliers, number of suppliers you are having, and future challenges, political pressure you have. So then, your suppliers, well then, company का करने आना उन्हें तो, वहाँ करने, वहाँ PS के देना लेना, आज super network. ठीक है तो मतलब political oriented relationship, एक development का business है. तो political party का करने आना मतलब operation में करने लगी. was people are sticker print current political campaign again sticker zone में एक है ये तो layout में मार profitable है तो ये party के नेता ना but political posters stickers sales banners sales में है but so you need to evaluate the suppliers and customers there is a stable supplier and customer portfolio is there to survive the business that's really important all those factors should be mixed with the financial ratio. Keep in mind. So, what question के exam के देना पड़ता है, what देना question के आदि qualitative aspect से देगा, qualitative type से देगा. एक का अनुमान वाले यहाँ पर click कराना, एक का समय mark थोड़ा कम. तो question के बाद अगर बारह में past papers वाला, you have a question with numbers with qualitative aspects. It may include customer satisfaction, employee satisfaction, research and development, futuristic plans of the organization. All those things may be included. So then you have to link all those qualitative factors with the final numbers. Right? That is the requirement. Right? So then that's it about financial ratio analysis. Area number 1, 80% done. So then we have remaining small part about other financial analytics like commercial financial analytics, ratio, not ratio, horizontal analysis, vertical analysis. This type of general analytics styles are there. So then we'll discuss that and then definitely next week. Half an hour, we can discuss all those techniques and we can close the area number 3. So the area number 3 all about financial analysis and the interpretation plus communication. So the communication is a crucial part. You should know how we are going to draft a proper report about the TV. So that's it for today. I hope that you had a detailed discussion about financial ratio analysis. Class, very good share. Right.